Your first job is not to make money, it's to survive. A complete operating doctrine from a veteran investor. Cold open, the most expensive lie in investing. If your first objective in the market is to make money, you are already positioned to fail. That sentence offends people, not because it is extreme, but because it contradicts everything they were told. From the first book they read, the first video they watched, the first success story they admired, they absorb the same belief. Markets exist to reward effort, intelligence, and ambition. That belief feels moral, it feels fair, it feels like how the world should work, and it is precisely why most people never last. Markets do not reward desire, they do not reward confidence. They do not reward intelligence by default. Markets test one thing first, whether you deserve the right to continue. 2. Reality shock. Why most investors are eliminated early. Almost everyone enters the market with the same silent assumption. Investing is about making money. So naturally, their attention flows toward upside potential, fast returns, scalable strategies, stories of explosive growth. They obsess over how much they can make, how quickly it could happen, how others did it faster. This assumption feels logical. It feels efficient. It feels unavoidable. It is also fatal. Because the market is not a profit distribution machine, it is an elimination system. It does not care how right you are, how hard you worked, how strong your conviction feels. The market asks only one question: can you remain functional under uncertainty long enough? Not brilliant, not correct. Functional. Most people cannot. They don't fail because their ideas are wrong. They fail because their objective is misaligned with the system they entered. They try to extract money from a system that first demands survivability. And the market does not eliminate them loudly. It eliminates them quietly. Through slow, invisible capital decay, emotional fatigue that compounds daily, overconfidence that blinds, then shatters, repeated self-inflicted errors that feel small. By the time most investors understand what went wrong, they are already disqualified. Not by rules, by reality. They didn't lose money, they lost the capacity to participate. 3. Core framework, the survival pyramid. To understand investing correctly, you must replace ambition with structure. Every participant, retail or professional, operates inside the same hierarchy, not because they choose to, but because the market enforces it. The survival pyramid. Level 1, survival, avoid elimination. Level 2, stability, stop internal decay. Level 3, consistency, prevent regression. Level 4, growth, allow compounding. Level 5, optimization, express skill. This hierarchy is non-negotiable. The most common error investors make is attempting to operate at levels 4 or 5 before securing levels 1 through 3. That is not confidence. That is structural fragility. Skill expressed without survival is just speed toward extinction. 4. Level 1, survival, the right to continue. Survival is not success. Survival is permission. Permission to stay in the game long enough for probability to work. At level 1, the goal is brutally simple. Remain capable of making the next decision. Not the next profit, not the next trade, the next clear decision. At this level, only one question matters. Did this action reduce my future options? Survival is violated when capital loss forces behavioral change, emotional damage alters risk tolerance, stress overrides execution discipline, urgency replaces patience. A loss is acceptable. Loss of agency is not. What survival actually requires. Survival is not about being conservative. It is about being non-fragile. And non-fragility requires constraints. 1. Capital fragility awareness. You must know precisely how much loss changes who you are, not financially, psychologically. Ask yourself, if this position moves against me, does my sleep change? Do my thoughts accelerate? Do I check prices compulsively? Do I start explaining instead of observing? If yes, the position is too large. Survival demands that no single outcome has the power to alter your identity or behavior. The moment a trade can change who you are no longer investing. You are negotiating with fear. 2. Time optionality. Survival requires the ability to wait without pressure. If your strategy needs fast confirmation, collapses without constant action, depends on short-term accuracy, then time is your enemy. Markets favor those who can remain inactive without emotional discomfort. Waiting should feel neutral. If waiting feels painful, your structure is already weak. 3. Cognitive load control. Decision quality degrades under overload. Survival requires limited inputs, repeatable rules, reduced exposure to noise. A system that demands constant interpretation will eventually exceed your cognitive capacity. The market does not punish ignorance first. It punishes overexertion. Silent pause. Survival is invisible. On screen, nothing impressive is happening. That is the point. Level 2. Stability. Stopping the bleed. Most investors do not fail suddenly. They deteriorate. Stability is not about making more money. It's about stopping invisible damage. At this stage, the key question becomes, where am I leaking energy, focus, and discipline? Decision frequency reduction. Every decision introduces variance. Variance in outcomes, emotions, confidence, discipline. Beginners believe more decisions mean more learning. In reality, learning plateaus quickly. Errors compound forever. Stability requires deliberate reduction of decisions. Fewer decisions mean fewer errors, less emotional disturbances, lower capital erosion. The market rewards restraint far more than activity. Emotional variance suppression. Financial volatility is tolerable. Emotional volatility is not. If outcomes trigger inflated confidence, self-doubt, urgency, storytelling, your system is unstable. Stability exists when wins feel procedural, losses feel informational, identity remains untouched. Without emotional compression, long-term survival is impossible. Identity separation. This is where most investors permanently fail. When performance defines self-worth, every trade becomes existential. Stability requires detachment. Results are data. Losses are feedback. Decisions are mechanical. Ego has no survival value in markets. Consistency is not improvement. It is non-degradation. It ensures discipline does not erode, rules do not loosen, behavior does not drift. Consistency is boring, and boredom repels most people. But boredom is the natural state of sustainable systems. Those who cannot tolerate boredom eventually manufacture risk, and manufactured risk is always fatal. The market is an elimination system. This is the point where thinking cannot return. The market does not select the smartest participants. It removes those who overexpose, overreact, overestimate control, underestimate uncertainty. Survivors are not special. They are simply intact. Why making money is a structural error. When money is the goal, time horizons collapse, risk expands, impatience dominates. When survival is the goal, risk contracts, decisions slow, probability accumulates. Markets do not require prediction. They require endurance. Those who endure long enough benefit from randomness instead of being destroyed by it. Markets reward durability, not brilliance. Only the right people remain. No instruction, no invitation, only a closing truth. If you are still searching for speed, this path will reject you. If you are learning how not to be eliminated, you are finally doing the real work. Silence.